Welcome to the Wealth Studying Podcast. This is episode 529. Today is July 28th, 2026. I'm your host, John Pugliano. I'm also the founder and money manager at investablewealth.com. Today I want to cover the tech sell-off or the perceived bear market in pretty much everything tech, whether it's hardware, software, chips, memory, fiber optics, or sensors. We're pretty much either in a bear or a correction market. I want to talk about that in terms of the reality versus the hype. Also, want to cover the situation with Chinese technology. That's a big part of this most recent sell-off. And overall, I want to give you my opinion on, if this is the .com bubble or not. So, hey, let's start off with the threat of Chinese technology. And really, when the media talks about Chinese technology, in your mind, you should translate that into Communist Chinese Party technology. The real fear shouldn't be whether another nation, whether it be South Korea, Japan, other Asian nations, whatever, it isn't whether another nation has better or superior or improving technology. It's whether an adversary has that technology. That's really what it all comes down to. That's not how it's discussed in the media, though. As far as the most recent fear in Chinese technology, I really think this is kind of, a 2.0 version. Remember back to the beginning of 2025, that's when DeepSeek first came out. That was the Chinese low-cost version of a large language model. There was panic for, maybe 6 weeks. Any sell-off that happened in either hardware or the hyperscalers soon evaporated, and those guys pretty much all went on to put in record highs. I think we're likely to see the same situation now for the same reasons. This isn't Chinese technology. This is communist Chinese technology. And there is, and going forward, will be even more bifurcation in terms of the global economy, specifically in terms of technology as to what's used by the U.S., and if you want to say the Western nations or U.S. allies versus the rest of the world. And I know people like to look at gloom and doom and think that today's the worst it's ever been, but go back to the first 30 years of my life and even, 2 decades prior to when I was born, and the world was in a Cold War. It was the West or the U.S. against what was then the Soviet Union, which doesn't even exist anymore. But it was a real present danger threat back then, both in terms of military, nuclear, economic, and there were 2 economic systems. There was the Western Bloc and there was the Soviet Bloc. It was a bifurcated world. It was that way in terms of industrial production, in terms of commodities, in terms of currencies, in terms of just general global trading patterns. And that all went away after about 1991, but we reverted back, and we are reverting back to more of a bifurcated world. I think it's going to get a lot worse before it gets better. It may never get better. But where that plays into the current fear about technology is that, number one, it doesn't matter how inexpensive Chinese technology gets. The U.S. is going to have a firewall around their own domestic use and production. It's not an accident that in the United States, Tesla isn't competing against BYD, nor is Apple competing against Huawei. There are trade tariffs and delineations in effect. They've been in effect for well over a decade now, and that wall is getting higher. The genie is out of the bottle. American companies that are using technology from Microsoft or Amazon or Alphabet, whether it's AWS or Azure, or whether you're using Google Cloud or Gemini or whatever it is, for security reasons alone, you are not willingly going to be switching to something from the Chinese Communist Party. And even if you wanted to, the government will be putting in additional trade barriers to prevent you. So the current fear over Chinese technology, number one, doesn't bother me for national security reasons. And then number two, the same point I made back in January of 2025 when DeepSeek first came out, my overall point then was, hey, even though it might be bad for OpenAI, who was the big dominant player back then, well, you know what? It's still good for the rest of the universe of technology, because the more something like large language models or artificial intelligence, the less expensive those models are. That means the more they'll be used. And the more they're used, that means there's more energy, right, needed. There's more electricity needed. That means they're going to burn more coal or use more natural gas or create nuclear power to supply that energy. And that means there needs to be more copper to move that electricity, and there needs to be more fiber optics to move the data. And there needs to be more switches and controls and sensors and routers. And there also needs to be more HVAC and nuts and bolts and everything else in the economy. And ultimately, whether it's Chinese technology that makes it cheaper or whether it's just the advancement in technology itself, it still gets less expensive. That's the whole point of technology. Technology lowers incremental cost. The most expensive computer system I ever bought was the first one I bought in 1987. Since then, every computer I've ever bought has gotten smaller internal components, faster, more memory, and on an inflation adjusted basis or even on a non-inflation adjusted basis, has still gotten marginally less expensive. That's what technology does. It costs a lot less to produce and distribute a PDF copy of a written document than it does to publish it with old school ink and paper. That's why over the last 40 years, the software and technology sector has grown exponentially, and the paper and publishing industry has pretty much, well, withered on the vine. So, next point. And this is a carryover to what Joe and I discussed in the last episode about Warren Buffett changing his opinion on technology and looking at this sector as more of a utility than as simply an algorithm. I want to reiterate that now. Yeah, there may be a sell-off in all these different tech companies depending upon what day you're looking at the market. But long-term, these companies' investments, it's like investing in an arms race. If Alphabet doesn't continue to spend to have cutting edge technology, then yeah, maybe their profits will look great today, but they won't be competitive in 18 months or 3 years. And so while these hyperscalers and other companies are investing in the infrastructure, whether it's data centers or power plants or distribution methods, or for that matter, whether it's semiconductor companies or memory chip companies expanding their capacity, they need to make those investments just like a utility company has to continue to build and expand and maintain its production capacity. Today, that spending may look like a drain on free cash flow, but what it's doing is building moats for tomorrow. Look at the companies that, years ago would have bought or paid a license fee for a physical copy or a CD-ROM of Windows 7. That was a one-time purchase, and they may not have upgraded for another 18 months or maybe even 3 or 4 years, depending upon what was being released and what their specific computing needs were. But over the years, technology has evolved, and it's just on steroids. It's evolution now with not only the large language models and artificial intelligence, but the next extension of them going into the things like robotics and automation and autonomous driving. I mean, all this data is more important than ever. And so you're not buying one physical copy or paying one licensing fee at a time. Virtually everything is on a subscription model. The software companies had gone to that years ago. We're now seeing almost the same thing happening on the hardware side. That most expensive computer system I ever talked about, at the time I bought it, it didn't even have an internal hard drive. I had to store everything on floppy drives. It was, I don't know, a year or so before I could afford to buy an external hard drive, which I think back then was like 10 or 20 megabytes. I thought I would never fill that thing up. Well, now something like memory isn't just something you're going to buy to use for the next couple years. I mean, the amount of data that we're going through and processing, whether you're an individual or whether you're a large corporation, your use of memory data storage is just growing exponentially. So companies that used to be extremely cyclical, like a Micron, where they had large feast or famines, boom and bust cycles based on demand that would come all at once, and then there'd be a refresh cycle that would last 3 or 4 years. Well, that refresh cycle is now less than 18 months. Same thing with fiber optics. Again, all these switches and circuits and HVAC systems, they constantly not only have to be upgraded on a much faster cycle, but they also have to be maintained because you can't afford to let any of this stuff go down. And so companies that before maybe just made hardware, now they're getting more and more of their revenue and their profits from the service contracts and selling spare parts. This is why Warren Buffett thinks that technology has moved more into something that he likes to invest in with more of a long-term value proposition that generates predictable long-term growth rates like the utility sector. Now, next topic. Are we in a bear market? Well, certainly just about everything in the tech sector has corrected one way or another. And even if it's up 20% this month, chances are 7 weeks ago it was down 15. And so while I agree with the headlines that talk about corrections, or really the big banner headline lately has been, technology in a bear sector, memory chips in a bear market. Yeah, technically that's true. A correction generally thought of anytime a stock is down at least 10% from its 52-week high, and a bear market being when it's down 20%. So technically, many, if not most things, at one point or another, again, over the past 6 weeks and going forward, probably over the next 6 weeks, will be in a correction or a bear market. However, you have to step back and look at the volatility. And this gets to the advantage of owning a diversified portfolio, because you'll notice the big swings and huge rotations that occur almost on a daily basis and certainly on a weekly basis. And this has been happening for the last 18 months. Whether it's Liberation Day, tariffs that spook the market one day and then a taco trade the next that reverses them, or whether it's, the deep seek fear of low cost Chinese technology, or whether it's more or less bombing and problems in Iran or shutting down or opening up Hormuz. I mean, all those things are causing major swings. But again, step back and look at the overall growth. In general, the overall growth of the US economy and specifically the stock market is not only resilient, it's growing at a rapid pace. So while it's technically true that Nvidia is having a major stock correction because it's down some 16.5% from its 52-week high, it's also true that on an annual basis, Nvidia is growing far faster than the overall economy or the stock market at, in the low double digits. And zooming out to the past 3 years, Nvidia is up well over 300 and some percent. So yeah, maybe on an individual day it's down 7, 8, 10%. But if you've been investing in this industrial technology growth over the last 2 or 3 years, then you've more than made up for these daily wild swings. And it's not just Nvidia. Pull up virtually any S&P 500 stock that's remotely or directly tied to the industrial technology trade, and you'll see the same thing. Yeah, Google nearly in a bear market because it's down close to 18% from its record high, which literally was like a couple weeks ago. But over the last 12 months, it's up more than 74%, and over the last 3 years, nearly up 153%. Microsoft, yes, officially in a bear market, down nearly 30% from its 52-week high. And it hasn't fared well in the last 12 to 18 months. because it's only up maybe 18% in the last 3 years. And while I can't predict the future, I can nearly promise you that Microsoft is not going out of business, and this is probably very likely an opportunity to consider buying into it. Same thing with Amazon. Amazon in a technical correction down close to 17%. It hasn't had a great 18 months or so, but still up like 75% over the last 3 years. If you have not your entire portfolio in any one of these big mega cap stocks, but a sliver of it here and there, then you're seeing long-term growth. And again, generally, when one is having a bad day, one of the other ones is having a good day. Meta, you saw the evolution that it's had, over the last 10 years, going from being just a straight social media stock to this crazy idea of the metaverse, and then getting back into its roots of online advertising and the stock going up exponentially, and then the recent pullback because they're overspending in technology. Yeah, they are definitely in a bear market, down over 25%. They've had a bad 12 to 18 months. But if you owned them for 3 years, you've made probably at least 82%. And getting into the real nitty gritty, the memory stocks, which in the last month have just exploded. Every Uber driver is telling you about how they're a millionaire in the SK Hynix IPO. Well, yes, memory has taken a hit recently. Micron down 35% from its 52-week high, which again was maybe 2-3 weeks ago. But look at its overall performance just in the last 6 months. Even though it's in a bear market today, if you owned this in January, you're up like 187%. If you owned this 12 months ago, you're up over 600%. If you've owned this 3 years ago, you're up well over, and I mean well over 1,000%. So it's a matter of perspective. I would not say these markets are in cyclical bear markets or corrections. I would say these markets are simply hypersensitive to daily and weekly and monthly volatility. And it's not so much that the market is crashing or that there's even a threat of something on the scale of a dot-com bubble occurring anytime soon. It's just a matter of rotation. And if you don't own 3 or 4 or 5 or a dozen stocks, but you own 100 or more, then certainly you're still going to see crazy variations from day to day. But overall, you should be making some substantial gains in the market over the last couple years. I mentioned the dreaded dot-com bubble. No, I don't think we're in dot-com 2.0 for a lot of reasons, but let's touch on that for a moment. And you've heard me talk about this before. Valuations now are nowhere near as crazy as they were back then. Most of those companies were not making any money, and even the big ones that were, the ones that survived and took a decade or more to get back to their price, their valuations were just insanely high. Nowhere near what we're seeing today. And I'll draw some parallels to that in a minute here. But think of it this way. Just remember, and again, you've heard me say this many times over the last 12 years this podcast has been on the air. There is such a thing as irrational exuberance. That's part of the fear and greed trade. But when Alan Greenspan coined that phrase, irrational exuberance, and he pretty much predicted the dot-com bubble, you have to remember that he was 3 years early. Had you sold everything on that day when he came up with that phrase, you would have missed the greatest stock market growth up till that time in history. And depending upon what you did or didn't own, you actually would have still been better off buying it when he said that, because it went up so much in the next 3 years that you likely would have still been profitable even after it pulled back, 50 to 80%, again, depending upon what stocks you owned. But the case being today, yes, there's a lot of spending. And again, a lot of the spending, particularly from the hyperscalers or from these major producers of very expensive technology, whether it's semiconductor chips or whether it's memory chips or whether it's the equipment up or downstream from those products, they're all very expensive to produce. And if you don't create the moat and keep up with the intellectual property and the manufacturing ability to make those products, then yeah, you may be saving money today, but long term, you're going to be out of business because you're going to be left behind. These companies, like utilities, have to spend money today, even if it means taking on a lot of debt, to build the systems that are going to be supplying that subscription model products and services in the future. If your electric company didn't take on all the debt to build the production infrastructure that it has, then they wouldn't be able to sell you the electricity you're using today. Like Warren Buffett, you have to come to that conclusion on technology. Now, as far as the dot-com bubble and their crazy valuations and their irrational exuberance, yeah, day to day, algorithms and hedge funds and Reddit readers and Uber drivers, they're all going to be herd mentality moving in and out of stocks. It makes things go up or down 5, 10, 15, 20% in a day. But look at the overall long-term trends, profitability, and fundamentals. And I've already gone too long, so I'm not going to go into all these, but let's just pull out the granddaddy of them, Nvidia. Its forward price per earnings. I know you think it's probably like 100 times or something, its valuation. No, it's not. Nvidia's forward earnings, its price per earnings ratio, is among the lowest and most reasonable among the large, well-known stocks within the S&P 500. On a purely nominal basis, its forward price per earnings ratio is less than 15 and a half times earnings. That's well under the average for the S&P 500, which is something like 20. Walmart is nearly 35 times forward earnings. Costco is even worse at nearly 43 times earnings. And that's just on a nominal basis. You factor in growth, and it's unbelievably worse for these retailers like Costco and Walmart. Very optimistic growth outlooks for Costco and Walmart are something like 11% a year. I really question that. The only way I think they're going to hit those levels is if they are large consumers of data and information and robotics and automation so that they can replace expensive human workers. But even if they get those 11% growth rates annually, remember, you're paying 35, 43 times earnings for that. Look at Nvidia. The PE is less than 15 and a half times, and the growth rate is likely to be well in excess of 30% a year and probably closer to 40 or 45% profit growth rates over the coming couple years. And again, when I talked about that refresh cycle, it isn't like someone buying a chip today is going to wait 4 years to buy a new one. This stuff is becoming obsolete in months, not years. That's how these tech companies become more like utility companies than they had been in the past. Hey, in any case, I do think there's a lot of instability in the market, but I would rather take the volatility, the ups and downs, for the potential and the profitability of investing in industrial tech sector than in these other supposed less risk and safer trades. Because again, look at Walmart or Costco or Home Depot or these companies paying large dividends or preferred stocks. And when you compare those valuations with where the industrial tech sector is, I think there's no comparison. Hey, just my thoughts. Until next time, John Pugliano wishing you the very best returns.